an IPO. In terms of just a little bit of housekeeping for everyone joining, could you please all just ensure that your microphone is on mute and that your videos are turned off, just to make sure that we don't have any issues with bandwidth. After this presentation today, we'll be sending around the slides that will be covered off today, along with an accompanying Going IPO publication, which has been released by RSM Australia in both English and Chinese. To provide a brief introduction of our three key speakers tonight, as everyone would have seen from the poster to promote tonight's event, our main speaker tonight will be Tim Goodman, who is one of RSM's lead corporate finance partners, and a senior member of RSM's China practice group. Tim has worked on over 100 Australian and cross-border IPOs and M&A transactions and has significant experience in undertaking IPO assignments, both locally and in foreign jurisdictions. Tim has assisted a large number of Chinese companies undertake transactions in Australia and fulfill the expansion strategy in Australia. And on that note, Tim has actually does travel quite extensively between Australia and Asia to assist companies with the IPO process. Tim will be joined by Dong Jie, our senior manager, and our assurance team, who will be speaking about audit considerations when it comes to the IPO process. Jie has 10 years experience in the assurance team here at RSM and has experience with a number of companies who have IPO'd in the past few years, especially in property development, IT, and renewable energy spaces. Jie is one of the leading audit senior managers for Chinese background clients and has similarly traveled throughout Asia as part of her work. And then our third speaker, Mary Lai, who is a principal in the corporate tax team at RSM, will speak from the tax perspective when it comes to the IPO process. Mary has 13 years experience in corporate tax and is fluent in both Mandarin and Cantonese. Mary is also one of the senior members of the RSM China practice group. Prior to joining RSM, Mary worked in an in-house tax role at a large global online media company and was also a tax manager previously at Deloitte before coming through to RSM. So without further ado, before we get into the substantive content for today, I'll hand over to our chairman of the ACAA, Mike Liang, to say a few words of welcome and to officially open tonight's event.
Hi, everyone. Is my voice okay?
Yep, I can hear you.
Okay, great. Thank you. Sorry for my background. I'm just on the go, and I'm actually in the car park and in the car, but it's a great event. It can't be missed. So thank you, Peter, and good evening, everyone. So I'm Michael Liang, the chair of ACAA. So welcome to tonight's event. A big thank you to ISM and the host of this event tonight. So Peter Xi, tonight's host, and the speaker, Tim Goodman, Jay Gu, and Mary Lai, as Peter Xi just introduced. So all of them are very experienced experts in their area. And Peter Xi is also an active member and a valuable member of our ACAA technical committee. So I'm so excited and to the topic tonight and the road to IPO. I'm not sure why my image disappeared, but I'm gonna keep going. So I'm very excited to the topic tonight and road to IPO. I had a quick check on the ASX IPO numbers today. And I think last year in 2019, we have nearly 16 IPOs. 60 IPOs. And this year, so far, the number is much lower. It's only about 20. And that includes the ones being scheduled. So I guess even though it's tricky time, but it's still time to plan IPO and think the future. So let alone ASX is one of the moments. So we all can see the ASX stock market increased about 30% in last 3 to 4 months since March. And so I can also see tonight's speaker pretty much covering most of the area of IPO, including capital advisory, audit, and the tax, which are all important integrated part of IPO. So I'm excited to hear more, and I believe there are going to be a lot of takeaway from tonight's event. So next, I just want to talk a bit more about our association, especially for those who haven't know us well. So first, we got a 3 pages PPT here to share with you. So first, who we are. So ACAA was founded in October 2016. That's about 3.5 years ago. And it is a not-for-profit organization. And it is governed by a governing board, and it is run by volunteers and by the committee. Like I just mentioned, Peter Shi is an active member of a technical committee. We also got other committee covering the day-to-day operation of the association. And also the everyday operation is also supported by our capable operation manager, Vivian, and her lovely volunteer team. So the purpose of the association, ACAA, Association of Chinese Accountants Australia, is to, like you see, connect people, empower people, and promote people, those people in Australian Chinese accounting community. So we currently, so if we can move to next PPT. So currently that's what we currently look. So currently we have 3 branches, NSW, Queensland, and Victoria. And we got about more than 300 paying members, and we got more than 1,000 WeChat group members. And we are also proud that we currently have more than 3,000 subscribers to our official WeChat platform. We actually running more actively since March, though we stopped the physical event since then. But we got more event coming up. We got more mutual activity through the social media and the Zoom meeting and YouTube. For example, I guess actually on this Friday we got a tax event for 2020 and tax return seminar. Anyone who are interested, you are welcome to join. And we also got a career event coming up, I think next month, 6th of August. And anyone who are interested can be turned on and keep your radar on. That is a most comprehensive career event. We're going to talk about each single position in accounting career. That covers, I think, more than 20 or 30 positions in accounting area. So pretty much that's all we do, and we would definitely welcome who are interested to hear more from us to join the WeChat group, and you can scan the code and to keep a radar on our activities and events, and you can also go to our official website as well. I think that's all from myself, and I give it back to Peter and our speaker from RSM. Thank you.
Thank you, Mike.
Great. Okay. So thanks, Mike. And Tim, over to you to officially kick off tonight's technical presentation.
Right. Thanks, Peter. Can everyone see the screen?
Yes.
Yeah. It's come up. All right. All right. Well, a very warm welcome to everyone. I understand we've got people from the mainland patching in, as well as people from all over Australia. So a very warm welcome from RSM, as well as the ACAA. We're going to talk about the IPO process, typically as it relates to listing a company on the ASX. A comprehensive guide is what that process relates to. Just in terms of a little bit of housekeeping, what Peter Shi said, we're going to provide these materials after the webinar. If we sort of get through this too quickly, and it is difficult to distill a listing process into a 1-hour presentation. We'll provide the materials afterwards, and we're also going to provide a listing guide that RSM's produced as well for your benefit. And just like the ACAA, we've got a WeChat QR code as well. So please feel free to come check us out to find out a little bit more about the RSM China Practice Group. Tonight, we're going to talk about 7 different topics as they relate to listing, and I'm going to cover the first 5. And they predominantly focus around why would you list on the ASX? What are the compelling reasons? What can a listing offer your business? Is a listing right for you? Some of the listing requirements, as well as the IPO process and timeline. And Mary, my colleague, will cover off on the tax structuring and other considerations. And Dongjie will cover off on the audit and financial reporting considerations to finalise the presentation. We'd ask that if you do have any Q&A, we'll address that at the end of the presentation. I think it's probably best dealt with there as a collective. In terms of why would you list the company on the ASX, and there's some very compelling reasons why.
Tim, sorry to quickly interrupt. The slides are just on the first cover page still. It's not moving.
See why list on the ASX, does that come through?
No, it's still just frozen on the cover.
Okay, let me
Yeah, maybe on and then
let me reshare.
Yep, sometimes it does free like that.
How's that?
Yep, that's good. Cool.
Okay, so in terms of why the ASX, it's got one of the largest pools of investable funds throughout Asia. So there's a lot of institutional investment in the ASX, and institutional investment brings a number of things. It brings liquidity and also an enhanced valuation, which is obviously attractable to potential entrants where you compare to other exchanges. The ASX has a very robust regulatory environment where we've got a very, very strict regulator here. And obviously the ASX self-regulates itself, but with that, it's got an enhanced reputation globally that we're extremely regulated, and with that gives credibility and reliance to a lot of the companies that are listed. It's got a long history of funding and listing early stage companies. The ASX is unique in the sense that it promotes and attracts and allows both pre and post revenue businesses. So if you think of the UK market, they've got the London official list. Then they've got a secondary exchange called the Alternative Investment Market. In the US, they've got the US Stock Exchange, and then the secondary markets, NASDAQ, where those secondary markets promote early stage companies. The ASX does both. So, it attracts companies from both ends into the spectrum in terms of early stage to mature. There's over 2,000 listed companies across multiple sectors and geographies. Obviously, China has been attractive or attracted to the ASX for a number of years now, and the ASX promotes itself to other emerging markets throughout the world. So it does capture a lot of businesses throughout the world, and is quite a popular exchange. In terms of accessing capital, it's got 45% of its investors are international. So that provides a great gateway into accessing global capital. So it gives you certainty that when you do an IPO, you've got a fair degree of certainty that you will raise the money, and it opens the doors to a lot of potential investors. It's one of the top 10 exchanges in the world for raising capital. And throughout the pandemic, the ASX has been the largest raiser of capital as a percentage of market cap compared to any other exchange in the world. So again, that goes to demonstrate the strength of that exchange. There are 132 new listings on the ASX in 2020. So again, demonstrating that there is a high volume of listings and companies are continuing to be attracted to the ASX compatible other exchanges throughout the world. All right, can everyone see the second screen? Is that all right?
Yep.
Oh, shit, that's fine. So what can a listing offer some of your clients or your businesses? Obviously an access to growth capital. I mean, that's what essentially a listing is for. You really want access to capital to take the next evolution of your growth strategy. So it gives you a platform to go and raise money very easily. It gives you a higher public and investor profile. So typically companies are covered by analysts, by the media, as well as being captured in industry spectrum. So that by virtue of that, that gives your business a higher profile in the public domain. And that creates demand for your shares, but also improves your reputation as well as a company, allows you to provide a greater service offering and greater product offering. It's got institutional investment. We touched on this before. This is extremely important in terms of liquidity, as well as validating the credibility of your business. You know, if an institutional investor is willing to go into your register, that really is a validation of your company and its valuation. So it really supports the longevity of the business, as well as the stocks trading on the market. Improved valuation. Obviously, once you go public, you're subject to the efficient market hypothesis, where investors have access to publicly available information in a timely basis. So that creates a greater valuation once you go public. It also provides reassurance to some of your customers and suppliers. Once you go public, it really goes to the strength and rigorousness of your business, that you're complicit with regulatory requirements, the broader corporate governance regime. So it validates them, both from a customer supplier perspective, that you're a good business to do business with. It also allows you to align employment and management commitments. So, for example, you can provide employee equity schemes where it allows your employees to buy into your strategy through the issue of shares, and then allow them to ride the valuation out if you're successful in your strategy. So it's very useful with executive remuneration schemes as well, to tie them into the strategy and allow them to buy into the valuation. It obviously provides a secondary market for your company's shares. So once you go public, obviously you can then sell those in the secondary market, not only creating liquidity, but further appetite for those shares as well. I suppose the most compelling question whenever you want to embark on a listing is just understanding, is a listing right for you? And it's not always a question someone can answer initially. And I suppose what you really need to understand is once you become listed, you've got increased regulation and reporting requirements. So typically public companies in Australia have to report twice yearly, both half yearly and annually, as well as comply with the continuous disclosure regime. So anything material that comes to light, you need to provide that disclosure to the market. So it creates quite a significant administrative burden, but also a much higher degree of accountability for both the board and the company. There's obviously privacy concerns. So once you become public, obviously your name's out in the public domain, as well as your history, as well as your ongoing obligations, as well as your strategy. So that can be seen as potentially anti-competitive, and obviously competitors have that information and can use that to your detriment. So you just need to understand, once that disclosure is made public, your business is basically out in the open. You've got increased public oversight. So I think this is quite relevant, particularly for Chinese companies, that once you go public, that's when really the hard work begins, and you can't run the company like you used to run it privately. And even though you may have control and the free float might only be 20%, you still, as a public company, have responsibility to the shareholders. So you've got to act accordingly, in accordance with the regulatory requirements and the ASX's exchange regime. So it's very, very important to understand that, that you need to act like a public company once you do list. There's obviously significant costs associated with listing. Typically, a rule of thumb is the offer costs are around 10% of the money that you raise. Now that can be a little bit more or a little bit less, but it's important to understand that listings are expensive, and you obviously need to engage advisors such as RSM from both the tax and investigating accountant perspective, as well as audit, but you also need investment bankers, lead managers, and very importantly, lawyers, as well as potentially other advisors such as geologists if it's a exploration IPO. So it's important to understand, the cost that's involved before you embark on an IPO process. And I think one of the most important elements is just understanding the time horizon. So listings can take anywhere between 6 months and up to 2 years, depending upon the complexity and size of the IPO. So it's very good to understand initially that you might be in a hurry to get listed, but very importantly, it's all about taking the time to get it right, because the ASX generally only gives you one chance to list your company. And if you're not successful, then they're very reluctant. They do not typically allow you to then have a second go at a listing process. So it's important to get it right the first time. Now, some of the listing requirements at the ASX really depend upon whether you're early stage or a mature company. So there's two tests that are applied depending upon what you're listing under, and the first one is the profits test. So when you're a mature business, you've got stable cash flows and you've got a business history, you're required to have 3 years of audited history, and that audited history needs to illustrate an aggregate of $1 million of net profit before tax. So that can be comprised of any way you make it up over 3 years, as long as it's $1 million. And secondary to that, just prior to listing, the ASX will go back and test that in the last 12 months, you've had at least $500,000 worth of net profit before tax just prior to listing. Alternatively, if you're pre-revenue, you can go under what's called the assets test, and that stipulates that you need to either have a minimum of $4 million of net tangible assets after deducting the cost of the offer, or a market cap of $15 million. So if you satisfy either of those two tests, you've effectively passed, probably the hardest test the ASX will throw at you before they apply all the other admission criteria. Now, also what's extremely important is what's called spread, and the ASX is very strict on spread. So you always need a free float, minimum free float of 20%, and then most importantly, you need at least 300 non-affiliated shareholders with a marketable parcel of $2,000. So non-affiliated effectively means no one related to either the vendor or the IPO process generally. So that includes advisors and so forth who might be entitled to script as part of the listing. So the ASX is very strict around that, and they typically only allow one address per shareholder for the register to determine that, and they do test that quite rigorously. So I've seen companies rejected from admission or were still delisted by virtue of not meeting the spread requirements. It's important that you don't have to have the free float or the required spread when you lodge your listing application, which is typically when you lodge your prospectus. But most importantly, when you go to list, you need to have that spread requirement in place and ensure that you can demonstrate that appropriately. If you do go under the assets test, there's also a working capital requirement that needs to be met as well. Obviously, if you're if you're a mature business with cash flows, you don't need to meet the working capital requirement under the profits test, but the assets test definitely requires a minimum level of working capital. So that's surplus working capital after you've raised the money. So it excludes things like cost of the offer, administration costs of being a listed business. So effectively surplus cash that can be used to carry out your stated objectives under the prospectus. So the prospectus will always include a statement that your company has sufficient working capital to carry out its stated objectives. So the ASX also will test this assumption quite rigorously, particularly as it relates to the source and use of funds. So it's important to understand that you need to raise enough money, not only to meet your objectives of the prospectus, but also to have sufficient working capital to meet the ongoing cash flow obligations of the business. Some of the ongoing reporting obligations once you list is you need to report half yearly and annually, and that's what's called a 4E. You need to lodge a 4E with the ASX within a prescribed period of time. If you do list under the assets test, you do need to lodge what's called a 4C, and essentially that's a quarterly cash flow statement. And what that seeks to achieve is when you list under the assets test, you're obviously disclosing how you're going to use those funds. That quarterly cash flow attempts to true up that use of funds and just give guidance to the investors that you haven't gone and spent the cash in another way, which is contrary to what your prospectus has stated and what they've essentially invested in. So that largely relates to mining and oil and gas exploration companies, which are pre-revenue and have got ongoing exploration activities. In terms of an indicative IPO process and timeline, look, you can largely do it within a 19-week period on the basis that you're ready. And I'll use that word very strictly. You need to be ready to embark on that process and be willing to go through the process as advised by both the ASIC and the ASX, as well as your advisors. So step one's really about appointing advisors. Step two is preparing the prospectus and due diligence. Step three is commencing institutional marketing. Step four is lodging the prospectus with ASIC. Step five is lodging a listing application with the ASX, which typically happens coterminously with step four. Step six is marketing in the offer period. And then step seven is closing the offer and having your shares listed on the ASX. I'm just going to talk about each of those steps in a little bit more detail because I think they're quite important to understand as part of the board process and just ensuring you've got clarity in terms of what they essentially mean. But in terms of appointing advisors, it's really important to understand who you need to be successful in regards to an ASX IPO. And the ASX does have discretion around looking at advisors from a credibility perspective. And they do have the discretion to refuse admission if they have issues with the credibility of some of those advisors. So it's important to appoint the right advisor, people who have had past experience with ASX listings, with ASIC, and obviously know the IPO market and process intimately. So it's important to have a lead manager, corporate advisor, an investment banker or stockbroker, an appropriate lawyer, an appropriate accountant, and for certain sectors, you'll need additional experts such as industry reports or geologist reports if it's an exploration IPO. In terms of weeks 2 to 10, that's largely about preparing the prospectus and undertaking due diligence. And I cannot stress enough the importance of due diligence in terms of an IPO. Due diligence is regulated by ASIC and the Australian Corporations Act. So what due diligence essentially seeks to achieve is to ensure what you've disclosed in your prospectus is factually accurate and verifiable. So what investors are investing in can be traced back to facts and reality. So there's such things as what's the company's business model, what are the risks, who are the management, what are the financials, the office structure, and anything else pertinent to someone making an investment in your company. And what that due diligence process is really ultimately seeking to achieve is what's called the due diligence defense. So what the company can say is that if for some reason an event happens in the aftermarket when the company is listed, you can rely on what's called the due diligence defense. So you can say to the market that you did everything in your power to do due diligence effectively and to ensure disclosure in the prospectus occurred. And there's various sign-off in the prospectus, such as the investigating accounts report that validates the disclosure in the prospectus to give investors certainty and comfort that what's been stated is a reasonable basis for someone to invest in the company. In terms of step 3, that's when you want to start your institutional marketing program. So the Corporations Act strictly limits advertising of the IPO prior to lodgement of a prospectus with ASIC. So you can't be marketing the prospectus prior to lodgement and approval by ASIC. But what the Corporations Act allows is marketing to sophisticated or institutional investors as part of a roadshow. So you can go out and market to them accordingly. And what that allows you to do is do one of two things: either a book build to make sure you can fulfill the offer in terms of the monetary terms, or price discovery. So just getting a steer on what you think the ultimate value will be on listing. And that's used basically as a mechanism then to set the offer price as part of the prospectus, which you ultimately lodge with ASIC. So once you're in the position to do so, you then lodge the prospectus with ASIC, and then you go into what's called an exposure period. And that largely lasts for 7 days. And in that period, ASIC is going through your prospectus fairly granularly and making sure that you've been complicit with the Corporations Act, as well as the disclosure requirements set by ASIC. And there's a regulatory guidance which sets out what needs to be disclosed in a prospectus. So they're just ensuring that, as well as just understanding, are you fit for a listing as a company? So if that offer period is extended, it's extended up to a period of 14 days. And that may be just to clear off any of the issues that ASIC's raised. Typically, once that 14-day period's expired, if ASIC are then happy with the prospectus, they'll then allow you then to basically go and raise the money. You cannot accept applications when the prospectus is in the exposure period. Conversely, if ASIC are not happy with the prospectus, they'll issue what's called a stop order, and that will essentially cease anything related to the prospectus occurring from that point onwards. So once the prospectus has been approved by ASIC, you typically lodge your listing application with the ASX at the same time or within 7 days. And then once you've done that, you can then go and market the prospectus and accept applications. And that marketing and offer period typically is around a 3 to 5 week period. If you've done your book builds appropriately as part of your institutional roadshow, you should have a lot of those commitments undertaken pre-marketing, and it's just a matter of looking at retail investment to generate spread and free float and fill the book. So that's a period between 3 to 5 weeks. And then once that's done, you essentially close the offer and you're admitted to the ASX, your shares are then allocated and trading commences. So that's it from my perspective. I'm very happy to take some questions once both Mary and Jer have completed their presentation, and I look forward to answering those in due course. Mary, I might hand over to you if that's all right.
Yeah. Thank you, Kane. Yeah. Can everyone hear me? Oh, yeah.
Yep.
Yeah, so good evening, everyone. As Team has mentioned, there's a lot of reporting obligation and transparency requirements. So preparation is crucial if a company is considering going IPO. So in order to prepare a company for listing, there are various tax issues that will need to be considered. So I'll aim to cover a few, just a quick summary in the next few slides. So first up, perform a tax risk review. A due diligence exercise will typically be required as part of the investigating accountant's report, and that was mentioned in Tim's presentation earlier. So performing a pre-IPO tax risk review will actually let you identify and tackle any tax issues before actually commencing the IPO process. So it's important to make sure that there's adequate tax records, documents, they need to be made readily available to be examined as part of this process. And also making sure tax compliance obligations are up to date. And second, develop or enhance tax infrastructure. So again, for the first time, tax disclosures will be open to public scrutiny. So it's important that there is a process in place that supports the tax reporting. And Tim mentioned that with the financial reporting requirements, you'll need to report half yearly and annually. And part of that, those disclosures, you'll need tax provisioning processes to be disclosed. So you need to have effective controls and also accurate reports. So now's a good time to actually consider adopting some sort of automated tax systems. And this could be tax provisioning software. This sort of technology-based software platforms will actually enhance efficiency and also allow consistency through automatic updates and standardized processes. And the next point, to consider enhancing the tax governance. So the expectation of listed public companies in relation to tax governance are significantly higher. So therefore, you need to have a tax governance or risk policy in place, and also ensure that finance functions are adequately resourced with effective tax controls and review procedures in place. So where companies have limited resources, they may benefit from actually outsourcing some of the tax compliance functions. Then if we move to the next slide. So revise or implement employee incentive plans. So as the business prepares to operate in a listed environment, it becomes increasingly important to actually secure ongoing engagement of employees, and you've got key senior management as well as non-executive directors. So this can be done through incentives such as issuing of shares or options. There may be existing plans in place, but now's a good time to revisit them if they need to see if they need to be modified, or there could be new incentive plans put in place. In structuring any sort of incentive arrangements, tax is always often a key driver. So for example, there are some generous tax concessions available, especially for shares or share rights acquired under an ESS employee share scheme of a startup. So it's important to consider all these considerations beforehand. Next, we've got to consider the impact of transaction costs. So if you recall in one of the earlier slides, step one is to appoint all these advisors. So along with this IPO process, there will be a lot of transaction costs that will be involved. And these costs could be incurred by the vendor as well as the business. So some of the common transaction costs will include tax advisors costs, legal costs, prospectus preparation costs, commissions or fees paid to investment banks. So you'll need to review carefully what's the tax treatment of this cost, as well as how you disclose these costs in the prospectus. So the income tax deductibility of these costs is not so clear, and there are a number of ways how they will be treated. So for example, you might be able to get an immediate deduction, or they get capitalized into the cost base of an asset, or they could be deductible over time if they're considered to be like business capital expenditure, which is deductible over 5 years period. So other than income tax, along with that, you actually need to consider the GST treatment of this cost as well. The reason being is there are some restrictions in place that could potentially limit how you limit the way you recover the GST embedded in those costs. especially if it's related to making of financial supplies, meaning, issuing of shares. So it's actually very important to monitor the GST incurred on the costs, as well as monitor the share register to ascertain whether shares are being issued to Australian residents or non-residents, which again would create a different GST outcome.
Okay. What was in the sandwich that you ate?
So was that, can we limit the questions to the end of the presentation, or was that a question? So I'll just carry on. So other than considering transaction costs, it's also important to consider impact of the company's tax attribute. So when we say tax attribute, we're referring to things like carry forward tax losses. So in order to utilize any sort of carry forward tax losses, you've got to satisfy the loss recoupment rules. And one of the most common rules that you would first seek to satisfy is the continuity of ownership test. As the result of the IPO, the continuity of ownership test may be failed, which means the test actually requires the company shares carrying more than 50% of all voting, dividends, or capital rights be beneficially owned by the same person at all times during the ownership period. So if that test is failed as a result of the IPO, then your fallback is the other test, which is the business continuity test. It is a fairly stringent test, so it's important that records are actually kept, maintained, so that in the event when you do need to utilize those losses, that you're able to substantiate what's required under the test. Lastly, here we also need to consider IPO, post-IPO dividends. Given the attractiveness of franking credits, so companies generally intend to frank dividends post-IPO to the greatest extent possible. To this end, it's actually quite important to maintain, monitor the franking account, and also consider the franking provisions. So there is a rule called the benchmark franking rule, which limits the amount that you can, or the extent that you can frank your dividends. So for example, if there's within a certain franking period, for the first distribution, if you've selected a particular franking percentage, then that kind of sets as your benchmark for the rest of the period. So the rule kind of, ensures that over a period of time, the franking credits are spread more or less evenly across members in proportion to their ownership interests. So whilst I've touched on post-IPO dividends, it's equally important to consider, pre-IPO, but keeping in mind, declaring any sort of dividend, there's a whole list of requirements that you need to be satisfied, and also depending on whether you've got availability of franking credits available. Yeah. So those were early pre-IPO considerations. Another big topic is obviously tax structuring. Tax structuring is important, and first up, we should, don't forget that there is a dual track process that may potentially be, beneficial. A dual track process pretty much means that you go down the path of the IPO, but at the same time, you also consider the potential of an outright sale. It is a strategic technique that's actually being used to create some sort of competition between, the general market as well as private investors in a bid to increase the sale values. So it's important to consider that, while you're going down the IPO process, there might be an outright sale that would create a better outcome for the vendors. The other consideration is whether you want to have a float company versus just a sale company. Importantly, you've got to involve your advisors and evaluate the most appropriate structuring option. So consider whether you want to actually establish a float company as a clean parent company and interpose that at the top. This may also allow existing shareholders to realize some of that investment in the company with a combination of cash and shares. And I'll touch on some of that consequences later on. So considering the tax implication of structuring steps is crucial in preparing for listing. So when we say pre-sale restructuring, it may be favorable in many ways. It could actually, often it's important to simplify the holding structure for ease of investment, and also create an efficient tax structure going forward for incoming shareholders. So there may be businesses in the, there may be certain assets in the business that you do not wish to sell, or there could be, real estate assets or other type of business that are not part of the IPO offering. So some of the examples of the sort of restructure that you can consider prior to an IPO will include potentially, combining or removing certain subsidiaries or businesses from the corporate group, reorganizing the funding that's currently in the structure. So that's referring to the debt and equity ratio, transferring any assets to a corporate vehicle from a trust or partnership. We've mentioned earlier that you can interpose a new vehicle, float vehicle, and also carve out certain assets. And I also throw in there that you could also consider forming an income tax consolidated group if that's not already in existence, but obviously forming a group would mean there are many other tax consequences that will need to be considered, but it could be beneficial in some ways. Whilst we've touched on income tax, there will be GST and stamp duty implication of the restructure that will need to be considered. So for example, if there's a transfer of business assets that's undertaken, it may potentially be done GST free if it's a transfer of a going concern. And from a stamp duty perspective, there are some exemptions in some states and territories where you can actually transfer business assets free of stamp duty between related entities. So finally, it's important to consider what are the shareholder consequences in undertaking any sort of structuring steps. So the tax consequences, obviously, for existing shareholders will always be a key consideration. If you issue, interpose a float company and issue shares to the public, and existing shareholders take up some of the new shares, but whilst, if they want to continue to be in the IPO business, there are certain rollover that they can rely on, script for script rollover relief. And this essentially means that you don't pay tax immediately when you receive the shares in the listed company. Instead, tax is actually deferred, and you pay tax when you eventually sell the shares in that float entity at a future point in time. So the availability of this rollover relief will be very important for those shareholders who plan to continue and retain their ownership post-IPO. And obviously, there might be shareholders that prefer to exit prior to the IPO. For those shareholders who prefer to exit, then they need to consider the tax consequences for them, and there may be CGT discount available for individuals or trusts if they've held the shares for more than 12 months. So in some cases, a seller may also be eligible for other small business concessions that are available to help to reduce that CGT gain further. So in some instances, they could get up to 75% discount on those gains. And finally, residency is also important in considering the tax outcome for shareholders. So non-resident investors generally are not subject to Australian capital gains tax on exit from their investment if the investment is not considered to be taxable Australian property. So essentially that looks at the underlying business assets to determine whether it's principally Australian real property. If it's not land rich, then in most cases those non-resident can benefit by selling their investment tax-free. So that's all I've got covered from a tax perspective. So just a final note that it is very important to get tax advisors involved at a very early stage, well before the actually embarking the IPO journey, to make sure that we consider all these potential tax factors. So I now pass to Dongjie to cover the next part of the presentation.
Cool. Thank you for passing on to me, Mary. Hello, everyone. Good evening. Can you guys hear me all right? I take it as yes. Okay. It's very nice to meet you all through this webinar. So in the past couple of years, me and my colleagues have been working with various clients who went through their IPO journey. So today, I just would like to share some of my experience in the IPO audit and also especially talking about the audit and the financial reporting matters you might need to take into consideration if you are pursuing an IPO. So in the next couple minutes, I'm gonna take you through to 3 areas. The first one will be your consideration around your accounting and the reporting system. And the second one will be what is the audit requirement for the historical financial data. The third one will be the consideration when you actually acquire a business in the IPO reporting period. So let's get started. So the first one is we're going to talk about accounting and the reporting system. So it is very, very important first step and the area you need to consider when you pursue an IPO. I would say the first question you really need to ask is whether you actually fully comply with IFRS or AASB in terms of your accounting policy and the disclosure requirement. So we all know if you are a listed public company, you have to be fully comply with IFRS. But if you are a private company and you in the past you don't have any reporting obligation under the general purpose reporting, you might actually have your accounting policy deviate from IFRS requirement. That's very, very common if you are a subsidiary of a group, and normally the subsidiary will reporting according to their own country general accepted accounting principle. What that means is thinking about if you have a parent company in China and you are a subsidiary in Australia, normally to simplify the consolidation process, the parent company will require the subsidiary in Australia to use the same accounting policy as the group. So in this case, your accounting policy might not be fully compliant with the requirement under AASB. Even nowadays, we all know, like in majority of the country, the general accepted accounting principles are already mirroring what in the International Financial Reporting Standard. It reduces some non-compliance risk to some extent, but it also need to pay attention to if there's any new standard issued by IFRS. For example, like in the past 2 years, we have AASB 15, AASB 16, and AASB 9 come into play. So different countries will have different timing of the implementation of those new standards. Also, for different type of the entity, the implementation date in different countries will also be different. So in that case, we need to give a little bit more consideration in terms of you just accepting what the accounting policy you are using in other countries. So this is the first example. And the second example will be even you are Australia private company and you don't have any parent company overseas, and but if you were reporting under special purpose financial statement, the disclosure in special purpose financial statement is significantly less than the general purpose financial statement. So when you go into public and the audit financial statement we need to prepare have to be fully compliant with general purpose requirement. So that means there's a lot of more additional disclosure required in that financial statement. For example, like related party disclosure, segment disclosure, and the risk management disclosure of the financial instruments. That's a lot of more disclosure requirements. So you have to prepare yourself, understanding what is the additional disclosure requirement on the general purpose. So that's also very important. And also, if you are a private company in Australia and you have never been audited before, there's a chance your accounting standard is not fully compliant with AASB. So it is very, very important in the very early stage to actually review your accounting policy and your financial statement disclosure against the requirement of IFRS or AASB to make sure you fully comply before you actually start the audit process. Okay, so the second one I really want to talk about is your accounting and the internal control system. So this is very, very, very important element when you start your IPO process. So you must that means you must ensure your company accounting system also include your IT system, financial reporting system, management information system, and all the internal control system are really capable of meeting all the continuous disclosure regime requirement. So if you not establish those well, it will pose a very significant issue after IPO, because as Tim mentioned, once you IPO, you have responsibility to the public, and you need to provide information, especially financial information, in good quality, timely disclosure. So you have to have all those good control environment for your reporting and the accounting system in place before you actually goes on to IPO. So your auditor, to some extent, will help you to identify deficiency in internal control during the audit process. They will normally make recommendations as well. But I think it's also very important to consider to involve other specialists to help you to actually establish a good control environment before IPO. Okay, so Tim, can we move on to the next slide? Thank you very much. So the next one we're gonna looking at is what's the audit requirement for the historical financial data. So as a general rule, so there will be 3 years recently complete fiscal year-end financial statement is required to be audited. So 3 years. And if your filing date is more than 134 days after the most recent complete fiscal year end, you have to provide interim report. So this is the interim report we are talking about now is actually referring the half year review. So the report also need to be reviewed by a company's auditor. And the just a side note, so the audit of the financial statement must be performed by an ASIC registered company auditor. So just please make sure check your auditor's qualification before you appoint them. Okay, then it comes to the very last one. This one is actually a very common and very normally will create a significant issues in the IPO audit. So this is when you actually acquire a company during the IPO reporting period, which is normally the 3 years financial. So if you acquire a company during those 3 years, you might, the ASIC might require you to get the audit financial statement for that acquired company prior to the acquisition date. So it's not just audited the financial information after acquisition, that you could be required to audit that prior acquisition day. So why is create complexity? It's just thinking about you have to find a way to get all the financial data of that acquired company prior to the acquisition. That will be hard. So also, how many years financial statement that actually need to be audited for this acquired company to decide the time frame. The rule is actually very complex. So my suggestion will be, if you acquire a company in the IPO financial period, do involve your auditor in the very early stage of the IPO process, so you guys can explore the option and the plan for the audit together, because it's not going to be an easy task. Okay, so this is my short presentation. I will pass that back to Tim.
Thank you both, Mary and Jeff. And I think, look, if anyone has any questions, I have seen a few come through the Q&A function within Zoom. We're more than happy to address those now if you like. So I might open it up to the webinar to sort of go through any of the questions you might want to ask.
Tim, I think someone left the questions in the chat box.
Yeah, I was just going through that as you said that. I think someone asked, is there a minimum market cap? There is. If you're going onto the assets test, you can either have a minimum NTA of $4 million post your offer costs, or a market cap of $15 million. So hopefully that addresses that one. And then someone said, what's the difference between the ASX 200 and the ASX 100 or 300 for that matter of fact? That's really driven by your market capitalization. So the greater the value of your company, that the more likelihood you'll fall into the ASX top 100 or the ASX top 200. And probably the best example of that is Afterpay. It obviously started off with a market cap sub $100 million. Now it's got a market cap of over $1 billion. And I think, from memory, it was one of the most valuable companies in Australia. So hopefully that explains that question. Did anyone have anything else? Oh, sorry, there's one more. I heard accounting firm cannot be listed. Is this right? No, that's not right. You can list an accounting firm. And in fact, there's been a number of legal firms as well as accounting firms list on the ASX. Probably the most well-known one is Crowe Horwath, which is now called Findex. That was a listed accounting firm, a lot of largely wealth managers, but accounting practices across Australia. Kelly & Co., which was another accounting practice which listed a number of years ago. And then there's obviously been a whole spate of legal practices, mainly IP or very niche areas of the law that have listed. But you certainly can list an accounting practice, obviously not as a partnership. It has to be a corporate model. So I'm just going through. Teng's asked a question. What is the minimum requirements for the number of shareholders during an initial public offering? Well, that comes back to that spread requirement. So you need a minimum of 300 non-affiliated shareholders with a marketable parcel of $2,000. So unless you have that, the ASX is not going to allow any admission. So this is probably one for you, Dongjia. Do the financial disclosure requirements apply to all listed firms, no matter of the firm size?
Yes.
Also, would you be able to touch upon ASX non-financial disclosure requirement?
So non-financial disclosure requirement, like changing of director, and also major acquisition. So any significant transaction of the company, they need to do continued disclosure to the public if you get listed.
Yeah, that's right. So it's that continuous disclosure regime picks up both qualitative as well as quantitative elements of your business. So, for example, if you execute a new contract, that would be required to be disclosed. Alternatively, if you recruited a new CEO or you terminated your existing CEO, you would obviously need to disclose that to the market. Hopefully not the latter, it's the former. So that, yeah, anything that the material you need to disclose. So very, very different regime compared to when you're private. You know, you need to be acutely aware of what you need to disclose and disclosing it in a timely manner. And there's also obviously issues around over disclosing. So there's what's called a price ramping regime. So people would disclose, you know, you've executed a contract, but that contract hasn't yet been fulfilled. That obviously has a value connotation. So if you announce it, you may get a value injection. So that the ASX is quite aware of over disclosing in cases where it can have a price ramping connotation. So, oh, Luna's asked me a question. What's the most common do's and don'ts in your past experience regarding preparation of IPOs? Luna, we've only got another 20 minutes, so we're probably not going to cover all those now. But I think it's very important to appoint the right advisors. So people who have done this before and have experience and understand the market and the regulator and the process and have worked with each other as well. So it's always good when you work with a lawyer you worked with before. It's also very useful to have the same set of tax advisors and auditor and investigating accountants. So you're all effective working cohesively. I think it's also important to ask those questions. You know, is a listing right for you? Because whilst an IPO might appear attractive and being a public company might give you a whole lot of benefits, it comes with a whole lot of costs as well, and they're not just monetary. You know, there's qualitative risks attached to those as well, like transparency. And you know, you've obviously been open to the public seeing everything that you do. So I think what's important is really asking the question: is a listing right for you, and understanding, you know, what the process is going to be, and then whether you're prepared to act like a listed company once you become listed. Because as I tell a lot of people, you know, the finale isn't when you list. That's the beginning of your journey. You know, that's the next stage in the evolution of your company. So it's a very, very different proposition. Yeah, so another question was, once being a listed company, how to quit? Are there any disadvantages for owners? Once you're listed, if you choose to no longer be listed, you need to undertake a delisting program. And then obviously you'd need to buy the shares back from the public company shareholders. So it's a reasonably complex process, and you need to obviously have the money to then affect that delisting. And there's obviously a whole bunch of different tax implications and regulatory requirements as a consequence of that. So it probably goes back to that question I raised before. You know, you need to be confident that a listing is right for you, because you don't really want to have to delist, because it's obviously very costly to do so, but then you've wasted a whole bunch of money listing and time and energy and transparency and whatever else. Yeah, this is one for you. If a private company which has a special purpose report need to plan 3 years in advance, starting on general purpose reporting for 3 years to meet the requirement?
I would say the early you planning, the early you starting reviewing accounting policy and doing general purpose financial statement, the better. You will, like when you're actually doing the 6 months to 12 months IPO process, you will be much easier, because as I said before, the financial reporting is all about your accounting system and your reporting system in place. So if you were previously reporting on the special purpose or your disclosure is heaps less, you might not preparing those additional general purpose disclosure requirement. If we wait until the year you want to list it, and go back to the past 3 years, you might not have the financial data you need to get all the complete disclosure requirement notes prepared. And you, if you review your accounting policy, you not comply with IFRS, you need to make an adjustment. But whether you have the financial data to help you to actually calculate the adjustment, that's another question. So I would say the early, as long as you still have a plan, for IPO, started 3 years early, like early in the stage, that will be better. Yeah. And we do have a lot of clients, they are thinking about the IPO in 3 years' time. They already starting get all their accounting policy right, and they are voluntarily doing general purpose financial statements starting now.
Yeah, I think that's right. It's much easier to proactively plan for an IPO than retrospectively go back and meet and try to fix up your accounts purposes of an IPO. But having said that, I mean, if you've been audited under special purpose financial reporting, the ASX typically doesn't require you go back and fix up the last 2 years. You can deal with that for the investigating accountants work, but is right. You will need to fully comply from a general purpose financial reporting perspective for your last year leading up to the IPO. So it's important to just get that timing right. Another person's asked the question, does the ASX accept companies to be listed in multiple exchanges? Yes, it does. You can be dual listed, and there's many dual listed companies on the ASX. So we just need to understand what exchange that company is listed on internationally. Some exchanges are obviously more favourable than others, but yes, a dual listing is allowed, and more often than not, it's a shortcut to the listing on the ASX because you've already got that history of being a listed company governance, and if it's a regulated exchange which is acceptable to the ASX, it's a short form listing process. There seems to be a few familiar names on here. I'm not sure if it's the people I know or not, but I won't call you out. So someone's asked another question. Is there any particular industry or entity which are not allowed to be listed on the ASX? And I suppose the way to answer that is there's obviously listing rules, chapters 1 and 2, that the ASX apply to your business, which you'd obviously need to meet before you start the process. So you need to go through that exercise. But typically what you do before a prospectus process begins is you lodge what's called an in-principle application. And that basically just sets out, and the ASX provides a template that you fill out, the structure of your offer, your business model, what you're contemplating raising, why, and a few other pertinent questions. And the ASX gives you guidance on whether they think you're acceptable as a company or business to list on the ASX. So they'll typically give you a steer. I mean, there's not really any, there's maybe 1 or 2 industries that they're a little bit negative on. Foreign currency trading's one that ASIC doesn't really like. A cryptocurrency has had a bit of a negative view on it. And look, there's a few other sectors as well. But most companies or industries are allowed, and there is particular structures, like you can't list a partnership, for example. So it's got to be some sort of corporate entity. Mary, did you want to add anything there, just in terms of structure or entities? I mean, there's obviously you can list trusts and whatever else.
No, I think you've pretty much covered all that.
Right. So another question is, what's the difference between a local company listing and a foreign company listing? Very simply, a local listing is you're listing a local company's shares on the exchange. If it's a foreign listing, you're listing a foreign company's shares. So foreign company share capital on the ASX, so you can't readily trade foreign company share capital. So you've got to trade through what's called a CDI, a CHESS depository interest. That's probably the main difference there. There's a few other peculiarities that need to be met, but typically the process is the same, whether it be a local or a foreign company. You might apply different accounting standards, US GAAP versus IFRS, but typically the process and regulatory requirements are very similar. It's just how the shares are traded. And look, it's just a formality in the background more than anything else. Another question is, if a listed shell goes into liquidation or voluntary administration, is there any benefits for the new buyer to buy the shell? Yeah, I suppose what you're asking there is what's called a backdoor listing. So instead of going through an initial IPO through the front door, you're trying to vend your shares into a shell and go through the back door. The ASX tends to be a little bit negative on that, because if your business has a good enough proposition, why wouldn't you just do an IPO process? I mean, there's benefits to acquiring a shell where you've already got a listed company, it's got spread, it might have a bit of cash, so you don't have to raise as much money through the prospectus process. But typically shells are shells for one reason or another. So they're generally tainted. So it's very rare you find what's called a clean shell. And then consequently, ASX have got a bit of a view on it. And inevitably, even if you want to do a backdoor listing, you still have to comply with chapters 1 and 2. So go through a full prospectus process. So, the cost is either the same or more. So yeah, look, I don't encourage shell deals or backdoor listings. They used to be pretty attractive 10 years ago, not so much now. Yeah, this is a very good question from Wendy. If a company failed on its first attempt at an IPO, is there a duration period for it to try again? And will the failure affect the future attempt? My answer is absolutely will. So you've only really got one chance with the ASX. And if you don't do it properly and you get some negative feedback and they're not willing to accept you, it's very, very challenging to change their perception and their opinion of your company. So you've got to get it right the first time. And that's where that in-principle application process is critical, is just testing the water to make sure they're comfortable with what you're contemplating from an IPO perspective, making sure you've got the right advisors and making sure you've got all the governance and regulatory protocols in place to be a listed company once you list. So you've only really got one chance in a nutshell. And the last question, no problem, Wendy, thank you too. The last question is, are the reporting requirements for first-year listed company the same as companies who have been listed for a long time? And the answer is yes, that doesn't change. If anything, they're more onerous, because you might have to go back and audit 3 years and pick up a half year, depending upon your prospectus process. So no, it doesn't change. It doesn't get any easier. If anything, and Jack can attest to this, it gets harder every year.
It is get harder.
More and more compliance.
Sure.
And every year it becomes more and more challenging. There's different accounting policies that get implemented, which requires greater oversight from the auditors as well as the company standing. All right, I think that's it.
Thank you, team. JJ and Mary.
No problem.
No problem, everyone. And
Thank you.
yeah, really thank you everyone for attending.
Everyone, thank you for your coming.
It's been an absolute pleasure, and I'm more than happy for you've obviously got our details. We're more than happy to answer any questions or come to a meeting. Probably not the mainland because we can't travel there at the minute, or Queensland, as I found out today. Probably don't want to go to Victoria, but look, more than happy to have a conversation about a potential listing or a potential opportunity, and help you and your clients or you and your contacts with anything you need as it relates to IPOs.
Thank you. Have a good night, everyone.
Thank you.
Thank you.
Thank you.